to get somewhat comfortable, with the previous concepts we were looking at with advanced market structure. So looking at those differences between swing, internal, and fractal structure. Now, the concept of order flow, you'll see as we go through this lesson, but it essentially is pretty much the exact same thing in the way in which we've been viewing price action through that lens of market structure. But basically you're going to be viewing the market the exact same way, but viewing it through the lens of supply and demand, right? So you've got market structure and then you've got supply and demand. But what you'll see is that basically the exact same concept, or they're two different methods for getting at the same point and viewing the market the same way, right? Now, so let me just kind of talking about that and throwing all these fluffy words out there. Let's just dive into this theory lesson. And as we go layer by layer, you'll start to see how they basically are the same thing, okay? So this basic order flow, you should be quite familiar with this from the initial supply and demand module earlier in the course, right? When we went through the theory of that, what do we know about price? We know that price can form a range, right? It can just be moving up and down, and then let's say price then breaks out of that range to the upside, okay? So this is our basic idea of how we form a demand range, right? How demand comes into the market. We have price kind of, at equal fair value, and then there's an overwhelming imbalance between demand and supply, where demand then overpowers supply and takes control, right? And then typically we'll see price pull back. It will then fill up more of those orders, right? Typically known as a mitigation, right? Traders mitigate those orders, and then we continue to the upside, right? So the very, very basic premise, you may have heard of this kind of phrase before, some people like to use it, is you have a range, it initiates out of that range, then you have a mitigation, continuation. So range, initiation, mitigation, continuation. It's just a very, very, way of just saying price initiates out, demand steps into the market, price comes back to fill up more orders, and then continues on to the upside, right? So hopefully you guys should be pretty familiar with that. In terms of how a demand range would work in terms of candlesticks, right? Let's say this was the M15 chart and you have a bit of an M15 range, you've got multiple candles, and then you see price go out. If you were to then look at this section of price action here on the 4-hour chart, what would that be? It would likely be only one or maybe two candles, right? And then you'd see one big engulfing 4-hour candle come out of that, right? And that would give you your 4-hour pivot, single candle demand zone, right? And then price would push back in. But if you were to go and investigate that bearish 4-hour candle that's then engulfed by the bullish 4-hour candle on a lower time frame, on the M15, for example, you would see potentially a bit more of a range, or maybe on the M5 or the M1, right? So on and so forth. This M1 range here, and you see a big swing push out on the M1 and come back in. What's that going to be on, say, the M5 or the M15? It's probably going to be one or two candles, a big bullish engulfing candle, and then a swing pullback, right? That's the fractal nature of the market. So that's kind of a quick crash course refresher on very, very basic supply and demand, right? How we visualize that on a chart. So the exact opposite for supply, right? You have a range, and depending on which way price breaks out, it just determines whether it's demand or supply. Obviously, if it goes to the upside, then we have demand. And if it comes to the downside, then that's where supply has taken control. So we get that initiation out of the range, mitigation of the range. Think of it as just picking up more orders where that supply stepped into the market. And then this is obviously where we want to then get in to try and catch that next movement to the downside, to catch that continuation. Okay, cool. Pretty simple stuff, right? Hopefully. Again, another simple concept, but you need to nail this, right? Basic order flow. When we have bullish order flow, the exact same thing with structure. We make a series of higher highs, higher lows, higher highs, higher lows, higher highs. Now, each of those pullbacks, right? Whether it's a swing pullback, whether it's an internal pullback, whatever, it's just price pulling back. That, when it then breaks the high, that whole sell to buy range, right? From the high to the low, essentially that green box, is demand, right? If it breaks to the upside, that's your demand area. That's your demand range. So anywhere within that box is where you have your demand range. Price then can pull back, doesn't have to, right? Price never has to do anything, but price can then pull back to do what? To mitigate that range. So we have a range, price initiates out of that range, then we get the mitigation of the range, and then what do we get? We get the continuation. Range, initiation, mitigation, continuation, right? Pretty basic stuff, hopefully. So that's what you'll typically see when you have nice, efficient bullish order flow, is you'll see price move up, it'll come back and mitigate that range, move up, come back and mitigate that range. Now, as you guys should hopefully, again, be very, very familiar with and comfortable with, is, we understand these larger ranges, but we want to be a bit more accurate with our price action. And that's why we look for smaller pivot demand zones within those ranges, right? To try and time catching those higher lows a little bit more accurately, rather than just entering on the entire range, right, where risk reward would not be on our side. So in terms of how you would draw these in the market, you literally, just very simply draw it from the high to the low and then drag it across to where price breaks, right? So if it was the opposite, if it's supply, then you drag it from the low to the high, or the high, it doesn't really matter what order you do it in, but you drag it across to where it breaks. So obviously, if price breaks out of the range to the downside, it's in a red box, it's supply. If price breaks the upside, then it's a green box, it's demand. There's not really too much else to say to this other than that we just expect order flow to continue, right? Price will come back and mitigate it, and it will continue to make those higher highs and higher lows. Likewise here, right? We have price breaks structure to the downside, it breaks out of that range, price then pulls back to fill up more of that supply and then continue to the downside. All right, so when you have a continued and sustained order flow, if it's bearish order flow, then each range is respected. So can you see how this is exactly the same way we view market structure? It's the same concept, because what do we expect with market structure? If this high breaks the low, right, then that is a strong high, and we expect that price will pull back, but it will not breach that high. So that's the exact same thing as saying, if the bearish order flow is going to continue, we expect that this range here that I'm dragging across, it will not be breached. Price will not trade higher than it, will not spike higher than it, right? If bearish order flow is to continue, right? So it's the exact same thing, but we're just drawing on these pretty boxes to visualize how it's supply in this instance, right? But they're the same thing, right? Hopefully you guys can see that now. So yeah, very simple rule. I just want you to know at this point is if the order flow is going to continue, right, each range will be respected until it's not. And then obviously if price breaks up, then what do we have? Then we have, that won't drag across for me. Then we have bullish order flow, right, starting to sustain, and then so on and so forth. So you can see how this relates to the previous thing we were looking in advanced market structure, whereby once we get that bullish I-boss to the upside, or it could obviously be a swing boss, whatever you want to use, right, then we would expect that bullish order flow to continue until it doesn't. It's the exact same thing here, but we're just visualizing it with supply and demand. Okay, cool. I think we should all be getting that. So now here's a little bit more of an not advanced, but just kind of the next aspect to that. So this is exactly what we were just looking at here, right, in terms of order flow, except we're zooming into this box just here, right? So sometimes, when you get a very, very large impulsive swing movement like this and there was no real pullback, when we then do get the pullback, we can be in a much larger swing range, right? So within that, we can get a lot of internal price action, which we've just been looking at, right, in the previous module. So let's break this down from an order flow perspective. Now, first, just look and cast your mind on the biggest swing. So we're just going to look at the swing highs and lows, right? So we get a swing movement up, we get a swing pullback, we then get a swing break of structure. So then all of this is basically just one big swing pullback, right? And then we get another swing break of structure. And then again, what do? We pull back and then we move up, right? Super, super simple. So what happened in terms of order flow just with that larger swing structure? Well, when we got that break of structure to the upside, right? I'll get rid of the orange line. From the high across, right? That here is your swing demand range, right? From this swing high to the swing low, that is your swing demand range. So what happens? Price comes in to mitigate that swing demand range, form a swing higher low, and then continue the next movement to the upside. So then that gives us this larger swing range, right? From the swing high, like this is how you would draw it. You would go from here, you would draw it from the swing high down to the swing low, right? And then just drag it across to where price breaks it. And that is your swing demand range of this current range in the middle. And then the exact same thing, right? We get from the high to the low to where it breaks, and then that's your next demand range. So what would we expect? We would expect the next swing pullback to mitigate something within this demand range and then continue up, okay? Hopefully you guys should be comfortable with that. Now, like I was saying, sometimes we can get big swing ranges, and this is where we've been diving into how we can be a bit more accurate with the internal structure within that. So after we have a swing break of structure, what do we expect? We expect a swing pullback, okay? So when we have that internal structure and it's giving us a series of internal lower lows and lower highs, right? So we get a bearish internal break of structure. What did we then expect when we were looking, when we were talking about the advanced market structure? We'd expect that to continue, right, until it pulls back. So we get that internal bearish order flow denoted by these red ranges, right? That's where each range is respected until what? Until it isn't, until we then get a bullish internal break of structure. So at this point here, now what has happened? Now price has mitigated some refined demand within the previous swing range, right? So this is when we're first expecting that swing high low could be formed. We then get a bullish internal break of structure to the upside to form a bullish internal higher high. So now the order flow, you see these series of red ranges, the supply ranges has now switched to bullish. So now we have this new range, this internal demand range, right, from the low to the high, to drag it across to where it breaks. And now we can look for what? Now we can look for those internal higher highs and higher lows, which we expect to continue until it takes out the week high. So this is exactly what we were just looking at before in the advanced market structure. We have the bearish internal structure, which we're now also referring to as bearish internal order flow. That then gets disrupted as we get a bullish internal breaker structure to the upside, right? So if you, like me, you want to see a candle closure for this, and then price falls back in to form a internal higher low, respecting this new demand range, right? Because now demand is in control. The internal demand or the internal structure is now aligned with the swing structure. They are both bullish. The internal order flow is now bullish, right? In line with the overall swing, bullish order flow. So now we're ready to do what? To take out that week high. And that's it. And then we expect those demand ranges to be respected until that high goes. Okay. And then the exact same thing would happen again. We'd come in to mitigate this larger swing range to form that higher low. And then we can look, for those same internal structures within there to happen, or we can dig down into a lower time frame, right? So yeah, that's pretty much it. The only other thing I forgot to say was that when we have this bearish order flow here and we're putting back, right, and then we mitigate something, some demand within here that then leads to the bullish internal breaker structure. The internal structure is then aligned with the swing structure, and we now have bullish order flow started to kick in. The bearish order flow has now been disrupted and has ended. Now these previous highs here become what? They are simply becoming liquidity to fuel this move here. They're like, think of them as liquidity targets. So if you're long, you can potentially target these for partials, because after we get those sweep of those highs, right, that facilitates a pullback. So like we get a break of that high, facilitates the pullback, right? We get a break of that high, and then potentially we'd pull back. So the way you want to view that essentially is, because all of these ranges have been mitigated, so price comes down, mitigates the prior range. Price comes down, it mitigates the prior range. Price comes down, and then we get the bullish shift in order flow, then we mitigate the demand range, right? So for price to pull back and mitigate this demand range, not always, but it's very likely it's going to have, mitigated some supply within here. But you have to understand that if the internal structure is bullish, if the order flow is now bullish, the internal order flow, especially when it's aligned with the overall bullish swing, if you're shorting from the supply, your expectation of how far that bearish move is going to go is it's just to facilitate that bearish internal pullback, right? We are not expecting this low to go, because this is now a strong internal low. Why is this a strong internal low? Well, because it took out the high, and now this we expect to be just a pullback to mitigate some demand within here. So you can short from these old supply zones that are going to be, potentially nested within here. Just draw it on, right? Over here. There'll be another one here. And again, you can short it, but you have to manage your expectation of what are you expecting this this old supply zone to achieve. We're just expecting it to facilitate a pullback into this current active demand range, right? And then we want to look to catch that strong high low to target the weak internal high. So again, it's all the same concepts we've been using the whole time. Nothing has changed. We're just kind of packaging them together in a more, cohesive, advanced way. It's the exact same thing. Strong highs and strong lows. Looking for breaks of structure, but we're just detailing into it and diving into it a little bit deeper, right? So once we get that first shift in internal structure, so it shifts bullish, so the order flow then shifts bullish, how you want to then interpret these prior ranges, as these ones have already been mitigated, is now think of it as like the majority of the supply in each of these swing ranges has been filled. So there will, of course, will still be some left, because like I just said, there will be maybe some unmitigated pivot zones, right? But you just want to view those, draw on properly. You just want to view those at this point now as just providing pullbacks into these strong protected internal higher lows, right? So now at this point, when this breaks upside, this will be a strong protected internal low, right? So price is just going to pull back if it comes off some old supply here, right? So the way you can also think about it is that because these supply ranges have been mitigated, there will be less supply within them, like the majority of the supply has been used up. So now this gives you it allows price to move easier to the upside. Think of it that way. There's less supply here to contain price. So now there's a bit more of a free path for it to continue up to the upside. And that's really it. Hopefully you guys should be quite familiar with this, or at least comfortable with it if you've spent time really understanding the prior concepts on advanced market structure. So let's take a look at one last theoretical example for this lesson. Right. So at first it can look like there's a lot going on, but we're just going to go through it nice and slowly. And I can promise you it's not. In fact, this is exactly the same as the example we just looked at, except we're just zooming in a little bit more into one of these bearish swing ranges. That's the only difference. Okay. So let's go through it again. Swing high, low, swing higher, high, right? So we get that swing break of structure. What do we expect after a swing break of structure? We expect a swing pullback. It doesn't have to, but it's most likely that that pullback is going to come down to at least the previous swing demand range, right? This green box. That's where typically we would expect price to pull back to, but it does not have to, especially if price is impulsive, right? We could just get that. But for keeping it simple, right, this is what we expect. And when price pulls back down into this demand range, that's when it's higher probability to then be looking for longs, right? And of course, if we're looking at actual supply and demand zones within that, we'd be looking for refined pivot zones, et cetera, et cetera. But for now, let's just focus on the ranges, right? Because we're looking at the overall order flow. So we have a swing break of structure, we're expecting a swing pullback. So if we then look at the internal structure, what do we expect? We expect that bearish internal structure to be forming with those internal breaks of structure to facilitate that overall swing pullback. Now, as we, let's get rid of those orange lines, as we start to come into that previous swing range, we have to start being aware, especially now we're in the discount, et cetera, that there's an increased probability that the swing high low is about to form, right? And obviously swing structure is the most powerful, that's going to take precedence. On this one time frame. So we have to start being aware that bullish pressure could be coming in, and we may want to start looking for longs, right, to try and catch that swing high low, right? So that's what we have to be aware in the back of our mind as soon as price enters the swing range. So typically what would we look for when we get that swing pullback? We would look for a bullish change of character to give us a signal that that swing high low may be in place. But now, we have a bit of a deeper understanding, right? And we now know that a fractal break of structure, so a chalk, this little break here, that is just the first signal that we're getting the internal pullback, right? So it's an aggressive signal that the swing high low may be in place, but really all it really confirms is that we're getting this movement. So we're getting the lower low, the lower high, and then that's one internal push down. But when we get that little chalk, all that means really is just confirmation that we're getting this internal pullback up to this protected internal high. Right, so for now, just think of the internal trend, this orange line here. We just have the larger internal trend, which is bearish, right? We come into the prior swing demand range, so we know there's an increased probability that we could be getting that next swing run. We get a little bit of a bullish change of character, so that's a sign that may be happening, but really the way we interpret that now is it's just to facilitate an internal pullback, and it's likely this strong protected internal lower high will not be breached. So we're just expecting this movement up here to then continue the overall bearish trend, right? That's the expectation. Okay. Now, within that overall larger pullback, right, especially if it's large price action, what are we going to get? We're going to get potentially like the internal of the internal price action that we're looking at, right? And you can get little bullish order flow within that. So it's only once then this low then goes, that then what can we know? That then that lower high, that new lower high is going to be in place, that new internal lower high. And once that breaks and then that bullish order flow shifts to bearish order flow, right? Now we can target that weak low because it failed to take out the high, right? So that's the internal range we were within, the larger internal range, right? We've got a bullish change of character here, which disrupts this little supply range here. So now we get rid of all these lines. That little bullish shock there gives us what? It gives us a small internal demand range. Price then comes in and mitigates it. Exact same thing. Price comes in and mitigates it. Price comes in and mitigates the prior range. Price then continues up, and then we get a shift from that bullish order flow, that small internal order flow, to that small bearish internal order flow, right? And we expect that as price comes in towards that protected larger internal high, then that gives us good confirmation that this is in play. And now this becomes sort of that higher probability move if you want to play that next larger internal leg to the downside, because now the small internal structure is aligned with the larger internal structure, right? So we now have small bearish internal order flow, which is aligned with the overall larger bearish internal order flow to now catch that next movement down. So now we can target here, right? So hopefully that makes a lot of sense. But of course you have to be aware that, it's still, we have to be aware of the bigger picture, and this could be the swing high low, right? And we could break up to the upside. But it's only once you get that high going, right, the actual IBOS, that then we have that stronger confirmation of that swing high low in place. So hopefully you can kind of see how all of these things relate, right? Don't forget we have the larger big swing structure with the higher high, the higher low, and the higher high. And then we have the slightly larger internal structure, right? Where it's making those lower lows, lower high, lower low, lower high, lower low. And then within that reg, right, you can have then the small internal structure, right? And you just help that to help you understand what's going on with this leg. And then once that small internal structure shifts, then we know we've got that, right? And we expect, once that low goes, what do we expect? We expect that small internal bearish order flow to keep continuing until the low goes, right? Imagine if it didn't, and then imagine if we broke up here, well, then we'd expect this small internal high to be run, right? You guys should hopefully be very, very familiar with that concept now, but we're just simply drawing on boxes to show you it from a supply and demand perspective. Okay, cool. So we get that shift in small internal order flow, and then we continue down, and then we take out that low. So that gives us another internal break of structure, which then means at that point, the larger internal range is from that high, right? Because this is the high that took out this low, and then this low here. So we pull back, all right, and then we continue that bearish order flow. So we get another internal break of structure. So now we're playing within this range. Right, so that gives us this supply range here, right? But then what happens is we mitigate maybe some extreme demand within here, and then we get a bullish break of structure to the upside, right? So now the internal structure, get all these lines, has now shifted bullish at this point here, and this is now where the larger internal structure has shifted bullish, but the larger bearish order flow is now bullish, right? It's the exact same thing. Where you get that internal break of structure is essentially where the order flow then shifts, right? So now what do we expect? Now we expect these demand ranges to hold until it takes out that weak swing high, right? Until it takes out the start of that bearish internal leg, which in this case is where the swing high is, right? So that's why when we get that shift in bullish order flow, that shift in the larger internal structure, we now expect these ranges to hold, right? Until they go the whole way up. And likewise, if it didn't, right? Imagine if we came up and then we switched bearish, then what would you expect? Then we would expect bearish order flow to hold until the downside, right? And we can draw those on as supply ranges, right? So we just have that, and you just expect that bearish order flow to continue, right? And it will keep being respected and respected until it goes all the way down. So hopefully that should make sense. We'll look at some very, very basic examples on the chart. And then in the next lesson, we'll go into kind of some slightly more advanced concepts on how we can, trade within all of these little movements. But it just comes back to that framework, knowing how swing structure works, knowing where your weak and strong structures are, and then just simply knowing that after a break of structure, swing structure, we expect a swing pullback. It's likely going to want to come down to mitigate the prior swing range, but it doesn't have to, right? But that's the general expectation. We then get the larger internal structure shifts bearish. So you can see it comes down and mitigates the prior range. It comes down, it mitigates the prior range, right? It comes down, mitigates the prior range, and it comes down. Then it shifts bullish, right? And then this moment here is when the internal structure is aligned with the overall swing structure. And this area becomes your highest probability buy in terms of that because it's all aligned. And then we expect those bullish demand ranges to hold until the weak high goes. And then we would repeat this whole cycle again and again and again, right? And that's what we expect. But what we've done in this example is just drill deeper into what can happen, right, in these larger internal pullbacks to look at the smaller internal order flow within that, right? Because you can have that one straight push down, but within that you get a little bullish change of character. And remember, chalk is just a signal that we're now getting internal pullback. An IBOS is then a signal that we're getting the swing pullback or the end of the start of the swing pullback. That's the way you want to think about it, right? Chalk signals an internal move. IBOS then signals the swing move, right? So what do I mean by that? That chalk here means we're going to get that pullback. That chalk there means now the pullback's over and we're going to get that run, right? Because chalk signals the internal swings. The IBOSes signal the swings, right? So when we get that bullish IBOS there, that signals that the swing pullback is over and the next swing pro trend run is going to go, right? And that's the way you can think about it. Now, what I will say is this might not necessarily be a chalk. That might be a small IBOS, right? It's going to depending on how big price is. So I appreciate that might be confusing for some people. So what do I mean? Well, we know we have this big swing movement down and then, internal movement down, and then we have internal movement back up. Now, in reality, in like the real life price action example, this small bullish internal order flow here, right? Imagine this is like, I don't know, 5 or 10 candles, right? So it's like a visual pullback that you can see and then a movement up. So then this movement here, we could call it an IBOS, right? It's just a small IBOS of the large internal structure, okay? Now, if that's the case and this is multiple candles, then what could happen up here is you could see like a little chalk. So that's when you've got like the one candle first to break the prior candle's high, and then we get a change in character. Okay, but that change of character there, all that signals is it could just be a pull back into here to then continue up, right, in that instance. So again, it'd be easy if I could explain with candles, but imagine this is multiple candles. Then we have a movement up, and then you get one little candle that fails to break the prior candle's high. So then you get a pop up and then a pop down. That obviously would be your chalk, but that at that point only signals that we could be pulling back to this strong low, right? Strong internal low, right? But it's only when you then get that IBOS that now we expect this movement. Okay, so that's in an instance in which the chalk could be here, but that's an actual IBOS. But then imagine that actually this is a really small movement on the candlestick charts. And this is just like that one or two candle that fails to break the prior candle's high. Then it's like just one candle that moves up. Then of course this would be a chalk. So hopefully you should understand that. And it's the same thing, right? You just have to understand in what particular sort of piece of price action we're seeing, what each thing means. But if you understand the hierarchy of what these words mean and then what they lead to, then that should make perfect sense. Don't worry if that's a little bit confusing as we go through different real life examples on the charts and the candlesticks. Hopefully that penny will drop and it will make a lot more sense. So yeah, I'll leave that there in terms of a bit of theory. We'll now just hop on the charts and quickly just practice mapping some order flow. And in the next lesson, we'll go through some slightly more advanced concepts. But as always, please take your time, watch this lesson as many times as you need to.